Hi folks, Scott here, and this is the wrap for Wednesday, July 10th. So markets hung tough today, just like we showed they may or might in last night's video. Today's video, I want to show you something I haven't tested in a long time because it hasn't happened in a long time, and that is the 10-day moving average is this yellow line here on this chart. This is the cash index, the S&P 500, the INX, and it closed today above the 20-day moving average, which is the white line. 20-day moving average. And yesterday it closed beneath it, so it got drug up above it today. In fact, if you measure it today, it'll look like it was still above it yesterday, but if you go back one day ago, it was not, as per my calculations. So what I want to show you, what are the results of fading gaps after the 10-day moving average closes above a 20-day moving average. And I'm going to show it both above and with and without a 200-day moving average being considered. All right, so this will be first simply the 10 crossing the 20, and there you go. Odds, it looks like almost a 10% greater chance of the gap filling if the gap is up tomorrow. So I'd call this a short bias. The gap down is not bad, but clearly odds favor shorts more than the longs, which appear to be pretty neutral. Now this is dead break even, but you need to, whenever you see an end of day study like this using an end of day stop, that's not something I would ever use with any sizable position for sure, if any. In the futures markets, you want to look at the largest losing trade, and these are considerable. So if you eliminate these two outliers, which you would with a traditional stop like we use here, 30% of the 5-day ATR, then these numbers probably turn profitable. Now check this out. This is for all market conditions. Watch what happens to these numbers when I add the consideration of a 200-day moving average. A lot of folks ask me, does it really matter? Well, sometimes it really does. It's just a different environment. There's a different mood of investors. Many systems key off 200-day moving averages as well. To watch these numbers, I'll update in just a second or two. Pretty interesting, huh? All of a sudden the numbers look much better. So and that's not surprising to me. Anytime you're below a 200-day moving average, price action just gets more volatile. Above the 200, it's more stable. You've got buyers confident in buying dips on a gap down after the 10 crosses back above the 20, which makes sense, right? You're above the 200. You've had some recent weakness. That's why the 10 is below the 20. Now it's crossing back above. Hey, they're excited. Buyers are buying the dip. That was a bullish scenario in their mind. A gap up, it's been weak. There's still some, as I think of it, there's still some bears in the house. The bears are still around. 10 is just now crossing above the 20. It's probably gotten stretched to the upside to do so, which is certainly the case here, and has a very high win rate. Again, this is using an end of the day stop. Now I'll rerun these numbers for our members using MTG stop parameters to confirm the tradability, if you will, of these two directions. But clearly a gap in either direction looks okay, at least using an end of the day stop, and if anything favors the shorts. All right, let's look at I'm going to skip the worksheet because we ended up with nominal gaps today. These are my pre-market comments. So I look at the worksheet and then I add any additional considerations like the ones I pose here in the videos each night. Yesterday's was a very positive one, right? Didn't matter which way we gapped. After 2 consecutive unfilled up gaps above a 200-day moving average, that's a good thing. And that's using our MTG stop parameters. So powerful numbers, about as high as you'll ever see. Oh, that should have been 17 of 19. Sorry about that. And let's see, fading up gaps after a 15-day high, at least a 15-day high close, 15+ day high close. That was not a 50-day high close and above the 200. Strong numbers in both directions. Well, I will show you this. The worksheets really favored pretty much either direction. There's one little chink there for fading down gaps on dojis, but we had good setups. Unfortunately, and this happens, somewhat, I'll admit, when you have good setups, they'll erode away into the open. That's what happened today. So we end up with flat markets, and I missed an opportunity. I would have shorted an up gap, just so you know. That's the whole point of showing you this. An up gap was pretty much a no-brainer in my mind, and I wasn't going to trade a down gap. The data was a little bit too weak. If you look at the individual gap guides, the zones that we would be opening in were just too weak. So nothing for me there, which means I go to plan B for the day. Plan B would be the 15-minute range guides. And let me actually bring those up and check these out. They favored the low fade the best. The high fade wasn't bad, but wasn't compelling in my mind. Excuse me. The low fade was compelling. Check it out. I'm looking for 55 and 1.1 weighted average for the low fade. Check. Nope. Check and check. 3 out of 4. So I got 3 points out of 4 there if you want to think of it that way. Looking at the ETFs, Spider confirmed. Diamonds, Qs, and not the Russell. So that's 6 out of 8 on the heels of 2 unfilled up gaps. I'm going to take that almost every time. And the market internals weren't real strong, but it's just 2 unfilled up gaps. You're more likely than not to be met with some buyers at some point. So that's what I did. Only trade I took all day. The first hour, if I showed you the first hour range guides, they were identical, which is pretty rare. They confirmed the setup completely. Opted not to add to the position. I was comfortable with the risk I had on. But I went long in the ES. The lines pay attention to the 2 purple lines with the 15-minute ranges, high and low. So this favored buying a test of the low. So I went when it tested it at 1645 and a quarter, one tick above it, around 1030, 1040, and I took some heat. But the guides, if you look closely, you can see the stop and target down here. But I traded the ES, 4.5 point stop, 4 point target. Sometimes I'll adjust them, but today I just thought it was a strong enough setup to trade it straight up on the rocks. And went long 1645 and a quarter, 4.5 point stop, put my stop at 41.75. Yes, it came close to getting me, but close doesn't really matter. It survived, hung in there, and then the FOMC minutes came out, and a little bit of a surprise, had added some volatility to the market action. Almost looked like a Fed day. Ran straight up on that bar and hit my target for +4 and then some. So a sweet trade for my only trade of the day. And Bernanke has been speaking this afternoon while I've been doing this wrap, and he has added a nice bid. So it looks like we could have a big gap up tomorrow. That just a heads up, if it's too big, I will trade it just like I did on, was it Monday or Tuesday, where I scaled out part of the position to lock in essentially a risk-free trade, and then try to ride the rest for potentially a full gap fill. So just a heads up on that. If it's less than 40% and it meets my criteria, which I don't know that it will, but I'm guessing it will since today would have, then I'll be pretty much going for most of the position for full gap fill, if not all of it. All right, but I got to check out my data. In fact, I'll post my data here in just a few minutes when I'm done with the wrap. Y'all take care. We'll see you.